Okay, so the next item that we have here is our fair value through profit or loss. Now, fair value through profit or loss, what it simply means is straightforward. What we are saying in essence is that we measure our financial asset or financial liability or equity, depending on what it is, we measure it at fair value. And when we measure it at fair value initially, any changes with respect to the fair value that we initially recognized and the fair value that we have at our reporting date, any changes between it goes to profit or loss. So for example, if at initial recognition we identify that this particular financial asset or liability or equity will be $5,000, and at the end of the year we notice that there has been a change and the value of our financial instrument has increased or decreased. Now, for example, if it's increased to 5,200, it then means that the 200 difference will be passed through profit or loss. And so if all you had was a financial asset and you are saying that your financial asset should grow to 5,200, so what that means is you will debit your financial asset and you credit your profit or loss, meaning that the credit will go through profit or loss. That's why they call it fair value that is true profit or loss. You might as well say changes in fair value that went through profit or loss. So that's really what fair value through profit or loss means. And for fair value through profit or loss, number one, we mentioned that it's a residual category. And what that means is that once your features of amortized cost and other comprehensive income are not met, you bring that asset or liability or whatever it is, you bring it to the needs of fair value through profit or loss and you measure it there. Now, another item to take cognizance of is that fair value through profit or loss applies to all financial assets that are held for trading. So if you have an asset that you intend to sell, trading means to sell. So if you have an asset that you intend to sell, then automatically what you do is you measure it as fair value through profit or loss. If you remember what we discussed earlier about the key feature of amortized cost is that we are holding the asset or liability till maturity. If you look at the example that we talked about, we said that the bank gave out that loan for 3 years with a view to holding that loan till maturity, meaning that they don't intend to sell the loan to somebody else. And so because of that, we've used amortized cost because we have identified that we are not selling the asset or the liability. But in the case of fair value through profit or loss, as long as we are holding the financial instrument for the purpose of selling it, regardless of what it is, whether it's a financial asset, a financial liability, or equity, as long as we are holding it with the purpose of selling it, it goes through fair value through profit or loss. And fair value through profit or loss is just the changes in the fair value from initial recognition till our reporting date, which goes through profit or loss. Now, because we are using fair value, at the point of determining fair value, impairment is always considered. So as a result of that, anytime you have fair value through profit or loss, you don't need to test for impairment at all. The fair value that you've arrived at covers for any impairment assessment. But under amortized cost, I mentioned that there is loss allowance that needs to be considered in your amortization. Meaning when you have your opening balance, your increase as a result of interest, and then your repayment, the last thing will be any loss allowance that will reduce it. But for the purpose of fair value through profit or loss, we don't do impairment because our fair value figure already has taken cognizance of impairment. So we don't do impairment testing for any asset that has been categorized under fair value through profit or loss. Also, we don't include transaction costs. So there's nothing like effective interest rates like we have under amortized cost, where we did say that for amortized cost, we apply effective interest rates because of the impact of transaction costs. But fair value through profit or loss, there's nothing like transaction costs. And if at all you see transaction costs, you recognize it immediately in profit or loss. So examples of assets or liabilities or equity that could go through fair value through profit or loss, one of the examples is derivatives. Derivatives are always through profit or loss because they are held for trading. They are always in the market. When you talk about forward, futures, swaps, options, they are always in the market, and so derivatives are always measured at fair value through profit or loss, except if that derivative is used for hedging purpose, and that's a different ballgame entirely under hedge accounting. Yeah, but for the purpose of derivatives that are just derivatives, for the purpose of derivatives, they are used and carried through fair value through profit or loss. Another example is loans. So if you have a loan or a bond that fail SPPI test, SPPI test is what we mentioned earlier in terms of solely payment of principal and interest, where I said that what will make an asset, a financial asset or a financial liability, to be categorized under amortized cost will be that what we are expecting on that asset or liability is solely principal and interest. And we said anything outside principal and interest fails that, and as a result of that, it won't go under amortized cost. You just bring it straight up to fair value through profit or loss. Financial instruments that have items that are not only just principal and interest, like the example I gave under amortized cost, where I said that a loan that has an interest that is linked to an equity index, because equity index is something more than a basic lending arrangement, we use fair value through profit or loss category for that. Okay, so that's pretty much it for fair value through profit or loss. We take an example here to see how that works in terms of the calculation and the requirements. Okay, so the scenario here says your bank gave you a loan of $1,000 and measures the loan at fair value through profit or loss. At year end, your bank could only sell the loan for $750 if it were to sell it. So how do you account for that? Account for that is pretty much straightforward. Your loan to your customer, which is by the bank, will be credit cash to release the fund, and debit the loan to customer. Now, we said that at the end of the year, there will be a change in fair value. So when there's a change in fair value, we have said that the asset is supposed to be $1,000, but it has fallen to $750 at the end of the year. The fair value changes will go through profit or loss. And as a result of that, what we are doing is we are debiting profit or loss with the fair value change of $250, which is the difference between the loan to customer balance at the beginning of the period and the loan to customer balance at the end of the period as a result of the fair valuation of the loan. So the difference goes through profit or loss, meaning you debit profit or loss and you credit the loan to customer, which is an asset, in order to reduce it. And if you look at this reconciliation here, it says the loan to customer less the fair value changes gives us the closing balance of $750. So that's pretty much how fair value through profit or loss works. It talks about the changes that is passed through profit or loss.